Ladies and gentlemen, thank you for joining us today. Welcome to the M&A Masters program and our first webinar in the 2025 program. My name is Samir Shah and I am an M&A partner in Khaitan's corporate M&A group. For those of you who have not joined us before, the M&A Masters program is designed to provide sophisticated education and inspire discussion on contemporary issues in M&A in India today. Today, we will be receiving presentations on four very interesting recent M&A deals in the form of case studies. In summary, we will have the case study presentations followed by a Q&A session with audience questions. If you do have questions, please submit them using the facility provided in the webinar portal. We have already received some questions as a part of our registration process. If we cannot cover all questions during the webinar, we will respond offline by email after the webinar. We will also be circulating a copy of the presentations, the summary notes, and a recording of this webinar to you after the webinar in due course. To introduce the webinar today, from a more foundational perspective, M&A is a very important part of our firm's practice. With more than 50 partners dedicated to this area, India is experiencing massive growth in M&A transactions. And as a result, every year we survey our M&A clients and associates in order to understand what are they interested in and how can we serve their interests better through programs like the M&A Master Series. One of the most common requests from our audience through these surveys has been for case studies on real life M&A transactions. You have asked us for examples of real M&A deals and lessons to be learned from those transactions. Today's webinar is a response to that, and we will be covering case studies on recent M&A transactions to explain how those deals were done and the important lessons to be learned from them. I do want to clarify, however, that transactions where we have acted for one of the parties, our comments will be based purely on public information and not confidential information for our clients. In some cases, the transactions and the names of the parties have also been kept anonymous. To introduce our presenters, everyone who registered for the webinar should have received an email carrying the summary of the presenters and their credentials. So I will not spend much time introducing them, but suffice to say that they are all experts in this subject matter and incredibly qualified to express their views and opinions on mergers and acquisitions. Our presenters today are each Khaitan partners working in the corporate M&A space, and they are Tanu Banerjee, Ashutosh Sampath, Purti Minawala, and Abhishek Dadu. So now let's start and bring in our first presenter, Tanu Banerjee. She will be presenting on the Reliance and Disney transaction. This was a deal that received a tremendous amount of publicity last year for very obvious reasons, and our firm represented Reliance. Over to you, Tanu.
Thanks, Amir, and good afternoon, everyone. Thank you for tuning in today. I'm going to talk about the Reliance-Disney merger in India, which I'm sure everyone has heard about, given how widely it was covered in the media. I'll start off with a general overview of the deal before this general overview of the deal. Now, before this transaction, Star India owned about 65 Indian TV channels under the Star TV brand umbrella and the popular OTT platform Hotstar. Disney acquired Star India in 2019, post which it operated in India largely through Star. On the other hand, Viacom, which was largely owned by Reliance, operated several TV channels under the Colors brand and also the OTT platform JioCinema. Now, the broader commercial intent of the parties was to form a joint venture and combine their respective entertainment businesses in India. To achieve this, Reliance Industries and Viacom 18 collectively acquired about 67% of Star India. Approximately 16% of the stake was acquired directly by RIL through primary infusion. A large chunk of the Viacom business was demerged into Star, for which Viacom 18 was allotted approximately 47% of Star's share capital. Disney eventually retained about 37%. The overall deal value was about 8.5 billion US dollars, which is roughly more than 70,000 crores in rupees. This amount included RL's direct investment of 11.5 thousand crores as well. The overall rationale for the deal was for parties to combine their market share, benefit from collective revenue that they could achieve together, achieve higher cost efficiencies by reducing overlaps. Secondly, increasing the monetization potential by combining their respective content libraries, and then also to combine their technological capabilities in terms of running two streaming platforms, JioCinema and Hotstar, to form a stronger and a more efficient consolidated platform, which will now be called JioStar. In terms of timelines, it took about 10 months end to end from when the initial diligence was started to signing the definitive documents, getting regulatory approvals, and then completing the closing process. This was a very, very short timeline for a deal of this size. Next slide, please. A quick look at the deal structure. Like I said, the broader transaction was for Disney's India business and RIL's entertainment business to be combined and run as a joint venture between RIL and Disney. To implement this, now on Disney's side, the TV channel business, which is all of Star TV channels, was housed in Star India, and Hotstar was housed in Star subsidiary Novi Digital. Star India and Novi were merged. Some of Disney's other businesses in India, which were outside of Star, like say National Geographic channels, a few Disney branded channels, these were also folded into Star India. There were also some offshore entities of Star which were used for overseas distribution of Star's content in different jurisdictions. These were also sort of restructured through separate arrangements. In parallel, on RL's side, RL's TV and OTT business, JioCinema, were housed in Viacom 18. These were demerged into Star India. Viacom was allotted approximately 47% in Star as consideration for the demerged business, and RIL directly subscribed to approximately 16% in Star with cash infusion. Next slide, please. Now, the overall impact of the deal is firstly that as a combined business, Star India is now easily India's largest entertainment company. In terms of current statistics, it has a major share in the digital streaming market in India, with more than 50 million paid subscribers across JioCinema and Hotstar. On the TV channel side, with more than 100 TV channels, the combined entity controls majority of television viewership as well. And then from a content perspective, currently the Star India JV has the right to broadcast most of the marquee sporting events. And it will own perhaps the strongest content library with more than 30,000 assets across movies, TV, and web shows. Next slide, please. Other than the usual deal mechanics of diligence and documentation, the deal needed several regulatory approvals at various stages. Firstly, NCLT was approached for demerger of Viacom 18's business into Star India, plus the merger of Star and Movie Digital. Secondly, MIB's approval was sought for transferring the TV channels owned by Viacom 18, which is the entire Colors bouquet of channels. And then, of course, approval of the Competition Commission was needed. The CCI application made for this transaction was possibly the largest in recent times, and it took several months of proceedings. Uh, Given how this transaction has resulted in consolidation of two of the largest entertainment giants in India, the CCI approval did come with some directions to the parties. For example, they were asked to divest from 7 TV channels. These were largely where there were jurisdictional or regional overlaps. There were also directions on sale of advertising slots across TV channels and OTT platforms, both in terms of pricing not being unreasonable or unreasonably increased, and also that the ad slots for certain sports events across TV and OTT should not be bundled together by the JV entity. But other than this, the CCI eventually did give its nod, and as such, no negative impact to the market was anticipated, considering the number of existing competitors in the Indian media and entertainment industry. Next slide, please. To quickly wrap up some major takeaways from the transaction, this was definitely one of the most interesting deals to be part of, and it did come with some great learnings. For instance, the scale of the financial and legal diligence exercise on both sides was massive, and it did impact commercial negotiations in terms of the scope of the transaction, the deal value, etc. And then, while generally speaking, the larger transaction was to combine the entertainment businesses run by Disney and RL in India, uh, each of the parties did evaluate their different business verticals and decided on what was to be combined and what needed to be excluded from the JV. Some of this evaluation affected how the deal was structured as well. There were several smaller transactions like business transfers, etc., each of which had to be individually implemented. On the competition side, the assessment had to be made not just for India, but for several other countries where Star and Viacom had presence. And therefore, the scope of this geographical analysis itself was quite massive, and very critical for presenting an accurate picture before the regulators. Tax efficiency was another aspect that played a crucial role in structuring the overall transaction. And lastly, I thought for all advisors on the transaction, sector expertise was really helpful to be able to understand the sectoral nuances from an operational standpoint. Also, to advise on proper contractual protections for all parties, which could be practically implemented and made sense in the overall scenario. And then to navigate through the regulatory approval process in terms of presenting the facts around the current business, market conditions, market impact, and to be able to juggle through the timelines. That's all from me on this segment. I'm handing it back to Samir.
Thank you very much, Tanu. And like you said it, what an eventful and momentous transaction for the sector. So now over to Ashutosh, who will be presenting on a fiercely competitive auction-led transaction. We have not identified any names and specifics for reasons we discussed already, but over to you, Ashutosh.
Thank you, Samir. Thanks so much. And thanks everyone for joining, taking the time to listen further. The detail to speak about, we acted for the seller in the transaction, the large financial sponsor. The target is a fast growing company in a very competitive sector. The seller had held this asset for about 6-7 years, being a financial sponsor at the end of its holding horizon, and it wanted to sell the asset. To sell the asset, the mechanism that was chosen was an auction process. In an auction process, generally the seller engages an investment banker. The investment banker then provides bids for various parties. A process is run. The asset is sold to a successful bidder. This is one of the largest exits that a financial sponsor has managed to achieve in India. And when we started this transaction, the seller told us that there were 4 key objectives that the seller wanted. The first is that they wanted an efficiency process. That means that they wanted to reduce the timelines, try and increase the value that they derive from the asset. The second is deal certainty. Once they've gone through the process, identified a successful bidder, they wanted to make sure that the successful bidder then closes the transaction as we were before. The third was price certainty. Once the price is determined in the SPA, it should not reduce when the actions signed. And lastly, the practice financial sponsor. Once the transaction closes, the seller didn't want any recourse against the seller for any liabilities pre-closing. From a timeline perspective, it's about 2 months from the time that we invited the bids to receive final bids. There's a very, very tight process. And even more tight process was from identification of final bidder to getting to the final executed SPA. That will be about a week from that. About 3 months from signing to closing, largely to account for regulatory and other conditions. Next slide. We spoke about the 4 key objectives that the seller had, and in the next couple of slides we discussed how these were went about achieving. First was efficiency of process. And for us to be able to crunch timelines, to be able to get through a process as quickly as possible, it meant a lot of preparation went in even before we started the process. That meant that the seller did a very robust due diligence. Vendor diligence helped in a couple of aspects. First is that it meant that the bidders had relevant information about the asset or the risks involved at the very beginning. So every bidder did not have to take an independent diligence. And the second is during the course of the diligence, the seller was able to identify any non-compliances that we have left in the ongoing business that allowed us to make sure they were fixed when the bidders came in the asset to see. The second experience that we've had in the auction processes is that whenever the seller wants an insurance-backed product, once a successful bidder has identified the time that it takes for the bidder to negotiate with the insurer, so it takes away from the entire efficiency of the process. That's why in this particular process, as the seller ourselves, we proactively approach insurers to quote from them to what's known as non-binding indication, which is a general overview of the topics that we then provide. The third, from an efficiency perspective, was that the entire process was very tightly controlled. The bidders were required to provide specific questions that they wanted for the diligence on. There were strict timelines that they were put, such that it was a disciplined process. And lastly, as sellers, we provided an auction SPA to the bidder, such that bidders could then mark their SPA and send it back to the seller. The seller could then do an apples to apples comparison to see what terms would be offered. The second aspect was important from a seller perspective is deal certainty. And in any deal, the biggest risk that there are conditions that we can satisfy is signing closing. And those could be broadly categorized in regulatory CPs and non-regulatory CPs. As far as regulatory CPs go, we made sure there were provisions which are ordinarily known as L or I water transactions, such that in the event that any condition is imposed by a regulatory authority while giving its approval, CCI for example, then the bidder is bound to comply with those obligations and does not have the option to walk away from the transaction on the basis that conditions are not accepted. As far as other CPs went, there were alternatives provided should a particular CP not be met. To give an example, we didn't want one customer to hold the entire deal hostage. So to the extent that a customer consent was required and it did not come through, the SPA provided that there could be other mechanisms that would sort of make the purchaser whole for that instead of termination, for example, reduction in the purchase value. The issue that's important is that no action should occur between signing and closing that results in termination of the SPA, and that's why, as per our SPA, the risk of the asset transferred to the purchaser on the signing itself, such that if an event were to occur post signing, that would not give the purchaser the right to walk away from the transaction. And lastly, to make sure that once the seller signed the deal on the closing date, it has sufficient funds to close the transaction, we insisted on appropriate proof of funds from the purchaser. Next slide, please. The next aspect that was important from a seller perspective is price certainty. Once you sign the deal, once the price is spec'd, it's not reduced when you get to closing. And the most common way of achieving that is having a lockbox mechanism for the purpose of price determination. That means that the price is determined as of a fixed date. More often than not, it's a date that even precedes the execution of the agreement. And no event post that lockbox date reduces the purchase consideration. The only exception to that is that to the extent that the seller extracts value for itself from the target, which are known as leakages, that reduce the purchase consideration. And the way that we went about in our transactions, that we have very clearly, objectively defined what those leakages were, such that when we get to closing, there's no dispute on that. Thirdly, like we discussed in our previous slide, the risk passed on to the purchaser at signing. So to the extent that events occurred post signing, that did not reduce the purchase consideration. And lastly, because there's generally a time lag between the date on which the price is fixed to the date on which you get closing, such that the seller does not lose out for the time value of money, we provided for a ticker or otherwise an interest that was calculated from the date of lockbox till the closing date. And finally, and especially because the seller was a financial sponsor, it was important for the seller that there was no recourse against the seller post closing. And the way this was achieved, of course, is by getting a warranty indemnity insurance in place. That meant that should the purchaser have any remedies for the purposes of either breach of warranties or other pre-closing liabilities, the sole recourse for the purchaser was against the insurer and not against the seller. The second is we then made sure that all leakages that were as clearly defined as possible were verified by third-party accountants pre-closing, and there was a determination on that such that there should be no questions around it post-closing. Thirdly, there were very limited post-closing covenants, so be it non-compete or non-solicit, they were very tightly defined for a very limited period so as to mitigate the risk of any post-closing claims coming through. And lastly, even though the attempt always is to be an absolute no recourse deal, some recourse is completely unavoidable. For example, recourse for fraud and other matters for which the insurer may seek subrogation. To the extent possible, we brought in time limitations either for the time during which the claim could be raised or otherwise the time during which the insurer would provide those subrogation rights. Next slide, please. So some quick key takeaways that we had from the transaction. One, of course, is that preparation is absolutely key in making the deal sale ready. That means getting a proper VDD done, fixing any problems that you see, and making sure that you have a proper insurance policy put in place even before you approach the third-party purchasers or bidders. Second, write a watertight contract that does not allow the purchaser the right to walk away from the transaction once the deal is signed. Third is protect your price. Make sure that once you arrived at a price, once you've written it down, then no event post the execution of the SPA reduces that consideration. And lastly, ensure that there's a proper warranty indemnity insurance in place. Start early, make sure that's a sole recourse, and to the extent possible that there are any subrogation rights to the insurer, you provide for limitation. That's all from me. Thank you so much. Over to you, Samir.
Thank you very much, Ashutosh. And that indeed was quite a stellar transaction. Now that we've covered services and product, perhaps we turn to infrastructure. And I will request my partner Purti to provide the third presentation for the day. She will be presenting on a very large private infrastructure transaction. Once again, we have kept the names and identities confidential for obvious reasons. Over to you, Purti.
Thank you, Samir, and thank you all the panelists for the interesting discussion. A very good afternoon to all of you who have taken the time to participate in this session today. We do hope to make this engaging and worth your time. As already mentioned in the introductions, I'm here to discuss a very interesting transaction that we did in the infrastructure sector over the last year. We will discuss some interesting learnings of these transactions and happy to answer the questions towards the end of the session. Starting with the deal overview, we have the slide up. Just to take you through the brief aspects of the deal, we were working for the buyer on this deal, who was a significant player in the Indian infrastructure sector. The target was an asset in the energy space, with the entities being based out of Singapore and 50 of their subsidiaries, which is an SPV typical in the given the nature of the industries. Interestingly, most of these SPVs were actually Indian entities, and we'll touch upon why this was interesting and crucial in this deal slightly later in the presentation. Coming back to the nature of the sellers, we had a total of 4 sellers, 2 of which were Singaporean based corporate bodies, and 2 of them were Singapore individuals. So essentially, this was an outbound M&A transaction that we worked on, which of course made it that much more interesting, but we'll get into that later. Having said that, we've discussed the target briefly. The deal value is, of course, self-explanatory, but given the deal size, despite the deal size, I must say, it was a cash-only deal, so there was no swap or issue of shares or anything involved here. So fundraising becomes that much more critical. Key elements of this deal. It was a strategic acquisition for the buyer. Our client was focused on this asset because it was a kosher asset identified very, very carefully by the buyer to meet its long-term objectives to being a market leader. CCI approval becomes that much more crucial given that it's a strategic acquisition and the deal size itself. In the nature of this deal, I think Ashutosh did mention that price certainty becomes crucial because it started as an auction process at some point, extremely competitive. And then at that point, the seller is running the deal. So they had emphasized enough on deal certainty and that price certainty. So that's why we also followed the lockbox accounts in this case with a right to know adjustments. And deal certainty, of course, we'll get back into more details in the next slide. Next slide, please. Having said the background, let's move into the key aspects and the challenges, so to say, that we dealt during the terms of this deal. Starting with the lockbox accounts that we touched upon. While Ashutosh did explain, we did follow a very similar approach. We did set up an upfront price with a kicker coming in to provide for capital contributions and other adjustments made during the time period and to value the investments by the seller. Having said that, what was different in this deal is there was no closing accounts adjustment that we received in this matter. What we will end up doing is we'll do an assessment when the buyer goes along, and if anything is identified, that adjustment will have to follow through later outside of the closing accounts mechanism. Moving to the next issue, the key approvals. Given that they were focused on deal certainty and the assets seemed to be kosher during the diligence process, the buyer did agree to very truncated list of CPs. An oxymoron to a transaction of this size. We had 2 weeks of negotiations to deal with only two CPs at the end of it, being the lender consents and the competition commission of approval. All of these are external dependency. If they were not in place, maybe we would have seen a simultaneous signing closing in a deal of this nature. But having said that, let's move on to the next one. Given that there was a price certainty involved, the warranties and indemnity had to be very carefully structured. The ask for the seller, as briefly Ashutosh did mention, this was also a competitive bid process. A no recourse deal was sought after. We were able to negotiate a few exceptions to this deal, but for confidentiality purposes, we will not be getting into details here. But having said that, we were successful in negotiating a few asks. But again, we have to also respect in a deal of this size and nature that the principles laid down during the auction process were well respected and not deviated from. Coming to the pre-completion covenants, what's different in infrastructure companies is these are all capital intensive businesses. So what works for other companies where you can't do a capital fundraise during signing and closing may perhaps not work for a each company of this size and this nature, which always involves needs cash on an ongoing basis. Uh, Combined with that, we also had to deal with the issue of being absolutely kosher as far as CCI is concerned. We had to be extremely cautious of the fact that we are not taking control of the company. There's no gun jumping allegations that come in. After doing that, the pre-completion covenants were very carefully drafted and carefully involved, while also being commercially very aware of what the needs of the company are, while also preserving the value of the company end up doing the closing. So that made for a very interesting discussions. And thank you to all the specialist team that we collaborated very well with, whether it's the antitrust team or the energy infrastructure team, to work through these list of items that we ended up agreeing on. Having mentioned that, the documents, of course, if this was a share purchase agreement, so the primary document was the share purchase agreement only. It was only with the Singaporean body corporates. We did replicate it for the individual sellers of Singapore, but given that these were more representative sellers, we had to make sure that we're not putting any liabilities while giving them equal right to receive the money under the document to reach this arrangement. In this deal, what was slightly different was also, like in other SPAs, perhaps because it was a Singapore document that came to us with UK law governance, the sellers did expect us to make payments directly to some third parties initially when the drafts came over, because it's a pattern that sometimes they expect a discharge directly to the LPs instead of it going to the sellers. We had to flag off that this is a no-go as far as our exchange control regulations are concerned. So negotiate that down to what is really permissible and allowed under our outbound regulations. Next slide, please. To move forward with this, what we did was, as I explained earlier, while the deal bid process did go for a period of 4 to 6 months, the negotiations only started 2 weeks, and slightly upsetting for everybody involved. It was during the peak holiday season. People had already planned their leaves. We started the negotiation in exactly during those 2 weeks and finished it end to end, walked out of the room signing the documents and announcing the deal. So that made it sure. But this also involved an extremely coordinated approach between everybody involved, because let's appreciate, the buyer was Indian, the sellers was Singapore, and the document was governed by UK laws. Besides that, we had to bring in specialists, antitrust, everything to be in place to make sure that we reach the goal in the 2 weeks timeline that was set for us. That had been extremely a huge learning, how to go ahead, put your head down and get the deal through. That became crucial in this deal. The next was customization, of course, of the indemnity package. Of course, I did mention in the beginning that the deal was no recourse basis. So how do you draw the comfort, given especially that we were acting for a buyer, Indian buyer, who may not be used to signing up to such terms? So how do you give them comfort? Which is a no-go for them, which is an item that we needed indemnity for? All that was still negotiated and agreed upon. So that became a crucial ask given the timelines of 2 weeks only, but we did reach an understanding there as well. Next comes to the pre-completion covenants. I did discuss how it was carefully drafted, given the CCI angle, given that it was a capital-intensive business. How do you tie it in together, think together while having only 24 hours to come back with a draft? That became a key learning in the stuff, which hopefully forever stays with the team involved in the transaction. And then, of course, the governing mechanisms related to payment and adjustment of purchase consideration. Crucially, as I mentioned at the beginning, the third party payments were expected, not allowed. On the other hand, the adjustments to leakages were not permitted because it was a no closing account statement. So we had to very carefully agree to leakage items and reverse leakage items, which of course can bring the price up or down. We ended up reaching an understanding, but it worked well for both parties, so hopefully it worked for everybody. But that was extremely a good takeaway from this transaction. With that, I would like to end my presentation. Over to you, Sami. Thank you, everyone, for being a patient audience.
You very much, Purti. And obviously, it was a very, very short time period to do a lot. But thank you very much for covering that. I will now invite our partner, Abhishek, who will present on a listed company takeover, where we as a firm did not have a role on the transaction, and our comments are based more on public information. Over to you, Abhishek.
Thank you, Samir, and thank you everyone for tuning in. Our fourth and thankfully final case study for today is the acquisition of an Indian listed company, which is called Manful Exports. This company is listed on the Calcutta Stock Exchange, and as Samir mentioned, our firm is not involved in this transaction. And though the deal value is quite significant, we thought of including this as a case study on account of its really interesting structure. So what's happened here is that the acquirers have sought to take control of an Indian listed company and at the same time also intend to take this company private. So they've gone under a route which is called a combined open offer cum delisting route. In brief, what this entails is you enter into a share purchase agreement for the promoter's stake, and in addition to offering to buy 26% from the public shareholders, which is your traditional open offer, in this case, they are offering to buy all the public shareholders of this company and in the process intend to take this company private. Now, what is the rationale for doing this? Of course, some of the key rationales are that you provide an exit to the public shareholders. You are able to offer more efficiencies to the company. As you would know, a listed company comes with a number of overhangs in terms of compliances, additional costs, maneuverability. If you were to take this company private, it becomes a lot more agile, and you're able to maneuver operations and management in a lot more efficient manner. Next slide, please. So, in effect, the structure of this transaction involved a share purchase agreement being entered into between the acquirer and the existing promoters of Manful Exports. Now, what is interesting here is that the share purchase agreement is for a mere 29%. So, what the acquirer is doing is that the acquirer is making an offer to acquire a total of 71% from the public shareholders. Now, anyone who's done listed company deals would be aware that getting up to 71% from the public is quite a challenging task. And therefore, this structure becomes quite unique and interesting because, in effect, what the acquirers are saying is that not only will I buy the 29%, but we are confident or we are hopeful that we can convince a total of 71% of the public shareholders to tender their shares and enable the acquirer to take the company private. Next slide, please. So let's, based on that, discuss how a combined open offer cum delisting works. What are its key features? The historic regulations on combined open offers come delisting was quite tedious. It involved a fairly complicated process of a open offer being launched, combined with a reverse book build process, in effect resulting in most open offer come delistings failing because the price that was achieved was commercially unviable. come December 2021, SEBI has revamped the law. Under the new regime, what SEBI effectively says is that an acquirer, for instance, in our case, can enter into a share purchase agreement and trigger an open offer, as was done here by entering into a share purchase agreement for 29%. Once you trigger the open offer, you have the option to rechristen the open offer into an open offer come delisting by simply announcing the fact that you also intend to take this company private. So in addition to the 26% open offer, you are now making an open offer come delisting for all the outstanding public shares. And in this case, that number is 71%. For the open offer come delisting to be successful, the threshold is that the acquirer should have in aggregate acquired 90% of the total share capital of the company. So to translate that into our case, what that would mean is that the acquirer would need to buy 29% from the promoters and an additional 61% from the public shareholder. So the 29 plus 61 takes the acquirer to a 90%. If you hit the 90% threshold, which is the magic number here, you have effectively complied with the minimum delisting threshold and your delisting will be considered to be successful. If you fall short of the 90% threshold, then your delisting is considered to have failed. And then what you do is effectively you go back to completing the open offer, which is up to a 26%, and the company continues to remain listed. Now, what are the key approvals that get triggered? First, of course, is a board approval of the target company. This is passed by simple majority. This is followed by a shareholder approval. Now, the shareholder approval is on a special resolution, but it is tested on two prongs. The first is a 75% present and voting, in which all shareholders can vote, including the promoters. The second, however, is a majority or minority, where effectively the number of votes cast only by the public shareholders in favor of the delisting should be twice the number of votes cast against it. Next slide, please. So in effect, what happens is that the acquirer would need to put in two prices to the public. The first price would be the price for the open offer. In this case, given the nature of the company, the price has been pegged at 5 rupees per share. So the first price is the price for the open offer, and the second price is an indicative price for the delisting. Now, under current regulations, the second price necessarily needs to be at a premium to the open offer price. And the commercial rationale to that is simple. I mean, if you're trying to take the company private, you offer a higher premium so as to convince the public shareholders that they should tender. And that goes back to the first point we discussed. Given that they're looking at a total of 61% outlay from the public, that price would in effect need to be attractive enough to convince the public to come and tender. Next slide, please. Now, of course, to protect the public shareholders, there is an entire process that is involved where the funds are placed in escrow so as to ensure that once the open offer process is done, the public is adequately paid off. Now, one of the key features that we see in this new delisting regime is that it is a lot more efficient in terms of time as well as cost. Earlier, you would have an overlay between the delisting and the open offer process, which resulted in the entire process taking about 2 months more than it currently does, and also resulted in a high interest cost of 10% for this period of delay, which is not the case anymore under the new regulations. Next slide, please. We've put together a basic diagram which sort of takes you through the structure on how the delisting come open offer process works. This can be something that can be handy once we email the slide deck to you, but this is effectively the process we've discussed today. Next slide, please. What we will go into next is to discuss a few key features of the combined open offer come delisting. Now, this of course offers a great structuring option for deals of this nature, where an acquirer is looking to not only take control of a listed company, but at the same time also intends to take it private. So rather than first launch an open offer, wait for a cool off period, which could typically be 12 months, and then launch a delisting, you have the option of combining both the offers at the same time and at one go offering the public the ability to sell their shares. And the process is fairly streamlined, with all the prices being determined as per historical market prices, thereby protecting not only the public shareholders but also the acquirer in giving him certainty on pricing. Next slide, please. Now, what are the key deal learnings that we have from here? One, of course, is that this deal, although I must say, for anyone who goes back to this deal, we have identified certain errors in the manner in which this deal has been launched. It appears that it was launched under the erstwhile regulations, but that's a process point. We're sure SEBI and the acquirer will be able to iron out those nuances in time to come. But what we thought was interesting here is the use of the combined open offer come delisting as a structure. This is arguably the first pure play combined open offer come delisting transaction in India. Of course, you had one before this, which was R Systems, which was combined with the concept of a conditional open offer. But this is a pure play 5A. And what we are hoping to see here is that this is effectively a watershed moment, perhaps, for deal structures of this nature, because it is overall a wonderful deal structure and it just needs to be adopted more often for public M&A transactions. Next slide, please. So finally, what are the key takeaways we have from this transaction? Now, the first key takeaway, of course, is that we are seeing adoption of an excellent structure that the law provides. Since its introduction in 2021, we've not seen many cases. We know as practitioners that this is a structure that many clients are currently exploring and have been exploring. It's good to see that it's finally getting taken up in real life transactions. There is a large element of commercial legwork that goes into such transactions in analyzing the public shareholders, whether they will actually tender their shares, what price you offer them so as to make it commercially attractive. This is a wonderful play between a commercially negotiated deal and one where you are effectively making an offer to the public, and you need to make the deal so sweet, so attractive that they will actually come and tender to you. Otherwise, in the process, you are the only loser. So with that, I end my presentation. Thank you so much for your time, and we'd be happy to take any questions after this. Back to you, Samir.
Thank you as always, Abhishek. And I must say, each time we do these webinars together, I always tend to wonder how do you stitch together such a complex set of regulations as are prevalent in public M&A. So with that, ladies and gentlemen, we come to Q&A. I must say that the Q&A box has been buzzing. I'll invite all of our panelists to switch on their cameras because I have questions for each one of you, which I will go one after the other. Maybe since Abhishek, your camera is on, I'll start with you. And it's really a follow-up on what you just said about the changes to this regulation 5A regime and so on. Do you expect more deals to come through using this structure?
Thank you, Samir. No, absolutely. We do expect a lot more deals to come through. I can tell you, of course, without taking names, that this is a structure we are contemplating for several of our clients. It's always about who's the one sort of taking the lead. You have, that one transaction which kicks off and then everyone follows. So I think that's one of the reasons we wanted to use this structure for this forum, because we truly believe that this will be a very viable structure going forward.
Interesting. So I'll take a leaf from what you said about following, and there's really very few people who wouldn't follow Disney as a very large media house. Coming to you, Tanu, the point that you made about Disney being a foreign entity, did the transaction require any overseas regulatory approvals? You briefly covered that as well.
Yeah, sure. And a great question also, Samir. Largely the merger was about Disney's India operations, right? So the transaction was generally focused on India-based businesses on both sides. The Competition Commission of India and other regulators in India sort of became primary. But even those India-based businesses had some presence overseas as well. Other than CCI, I think significantly, I'd say, antitrust authorities of some jurisdictions where there were significant overlaps in terms of operations, they were approached. At the top of my head, I can think of EU, China, South Korea, Ukraine, right? So all of these authorities were in parallel approached as well. Independent applications were filed, and so on. So yes, largely it was India-based. Largely it was the lookout of Indian authorities, but there were some regulators, offshore regulators involved as well.
Sure. And just in terms of the same transaction, maybe we stick with you, Tanu, on due diligence.
Yeah.
Just the sheer size and scale of the business and given the level of parties involved, you would expect extensive diligence, but given the tight timelines, how do you balance both of those interests, which is to get just the right amount of due diligence done?
Yeah, I think the due diligence on this deal is something I'm going to talk about for the rest of my life. Uh, just how massive it was. This deal was, anything but a regular deal. And the diligence size was massive. One, because both of these businesses were so well established, they've been existing historically for decades. The scale of their businesses was so large. And then, of course, we had such strict timelines to cover everything. So it was, quite an exercise. But I think what we did is in terms of, and you're right, in a deal of this size, plus the timelines, looking at everything together, it's impossible to look at everything, but it's also the approach also can't be that we compromise on something or something gets overlooked. So what we did is, and this is, of course, this was discussed with Reliance and the clients, we did some materiality thresholds in terms of, let's say, top shows, top IPs, top movies, uh, plus contracts which were, let's say, high in value or otherwise really critical to the operations. And then naturally, because it was an entertainment sector deal on both sides, there was a, I would say, slightly more focus on things like IP, disputes, technological infrastructure, those sort of things. So we had kind of identified what is really crucial, not that anything else was not crucial and to be overlooked as well. But that sort of worked in terms of just looking at everything and covering the scale.
Understood. And imagine that sort of pressure in a bilateral transaction. And
Yeah.
we have a lot of questions on, and maybe Ashutosh, if I move to you, around how do you compare and how do you help a client judge where is perhaps a bilateral better over an auction and where is an auction better? You got fantastic results in your auction process.
Yeah, it's a tough call, Samir, to be honest, but an auction process works really well where the seller wants to be in control of the process, where the intent is to maximize value, especially for financial sponsors because they have a fiduciary duty towards the limited partners that they have, the investors that invest in the private equity fund, for them to be able to show a transparent process of price discovery and value maximization. For most cases where there's a financial sponsor seller, we see an auction process being run. Uh, Again, in competitive markets where there are a lot of bidders, where there's a lot of interest, auction processes are preferred. But there could be situations where an auction process is not ideal. For example, let's say when the seller is in need of funds immediately, or if the target is trying to sell itself in a distress situation where it's a melting ice cube situation for the target, an entire running of an entire process for an auction may not be entirely feasible for transactions like that. Maybe it's better for the seller or the investment banker that the seller engages to reach out to targeted uh, bidders, purchasers who can then do a bilateral sale instead of doing a full long auction process. That's one. Again, in other situations, a strategic buyout may make more sense. A bilateral buyout where there's already some large player who's looking for consolidation, so it's really an obvious buyer for that particular asset. So again, would really depend on what the asset is, what stage the asset in, who the seller is. But yes, I think it's a question that needs to be answered for every transaction, and the seller will have to take that call depending on what best suits its requirements at that point.
Understood. And I believe you used WNI as a very effective tool. There are a bunch of different questions on no recourse, WNI, limiting the warranty cover. So before I move to Purti, Ashutosh, really, in your experience, this transaction included, how easy was it to sell the WNI concept to bidders, and how quickly did they wrap their arms around this entire construct? Did you have to push it through? Were they willing and able? What was the thought process?
So, Samir, at least as for the transaction I spoke about, was a very competitive process, and to that extent, the seller had relatively better bargaining power. Also, the fact that it was a financial sponsor selling in our case meant that it was a non-negotiable for them, that there was no recourse deal for them. From a buyer's perspective, also it was important that they could go after for pre-closing liabilities in case of a financial sponsor. There are time limitations as to how long will the seller as an entity survive. So it wasn't very difficult in our case for us to be able to sell it. But yes, it's gaining traction in India. It's not as if every single deal is a warranty indemnity insurance backed deal. I would say in most mature markets like the UK or the US, it really is the norm that you have a warranty indemnity insurance. Uh, in India, it's gaining traction. Takes time. In other deals, especially bilateral deals, the buyers do sort of take some time to sort of wrap their heads around the entire process, whether they want to take it or not, who bears the costs. There are many aspects that come into play. For example, there's a question of retention, the question of who bears the first loss. I think those aspects get negotiated, but the way that I see it, increasingly we'll see this as a product that de-risks the seller and also benefits the purchaser in the long run.
Understood. And this concept of non-recourse clause, I think Ashutosh, you spoke about it. Purti, you also spoke about it. So, Purti, maybe if you want to take this, there's a question on the enforceability of this sort of a non-recourse clause, and really, how do we see it playing out in the event of a dispute or future claims?
Yeah. So Samir, that's interesting, and thank you for whoever asked that question. So yes, we have analyzed this, we worked on it, but to our mind, yes, it can be enforced. And yes, rather than looking at it as a positive enforcement, which requires positive covenant, which requires sword-like enforcement, it's more of a shield in case of a demand that arises later. Separately, there is enough jurisprudence on the subject to say that if you identified a quantity of damages in the agreement, can you perhaps go beyond it? Yes, no question, has been analyzed too many times. Of course, we have also discussed the juxtaposition between the section 23 of the Contract Act, which says anything that excludes remedies is not enforceable, as against 73, which says damages is there. After reaching all these points, we do know that, or understand or appreciate that it can be enforced by limiting the amount that can be recovered. So, in deals of nature like what Ashutosh mentioned, or my deal perhaps, you would insist on spelling out that in case of any losses, the maximum amount will still be capped. The reason for mentioning that is to use it in case the damages claim does come in later at some point of time. But with that, yes, the summary would be it is enforceable. Of course, to be tested
Understood.
at some point. Yeah.
Right. And Ashutosh, your thoughts on the entire subrogation right that insurers seek, and how do you manage that from the perspective of a seller in the kind of transaction that you were looking at?
Sure. So the context, of course, for an insurance is that it provides no recourse against the seller. But there is one exception to that, generally both under contract and under law, that if the party that is taking benefit of that insurance, if it were to commit a fraudulent act, then it can't really hide behind the insurance and say go after the insurer. In that case, generally the insurers insist on a subrogation right, such that if the purchaser raises a claim for a wrongful act on the part of the seller, the purchaser is made good by the insurer, but then for the amount that is paid to the purchaser, the insurer reserves the right to go after the seller and recover monies from the sellers that have been paid to the purchaser. The one way to try and sort of limit the liability there as well is to try and bring in limitations. Again, enforceability of that will have to be tested at an appropriate time. But at least from a contractual perspective, what sellers try and do is to try and mitigate their risk in two manners. One is to say that a claim for fraud should arise within a reasonable period from the closing date. So let's say a year, 2, 3 years. The purchaser's then been in the business for a long enough time for it to discover a pre-closing fraud. So that's one. And the second is to the extent possible, there again, you try and, like Purti said, limit the liability to a particular capped amount, such that the sellers, they're not liable for an amount that's larger than that. That would mean that the purchaser would also not be able to claim a larger amount from the insurer, and consequently, the insurer can't go after the seller for an amount that is in excess of that cap.
Fantastic. So I'm conscious of time, Abhishek. There are two questions I want to bounce your way. The first is really this entire regime change. I know you briefly spoke about it during your presentation, but if you could throw some more light on what is the distinction between what was there before and what is there now. And from the earlier question, there is a question for crystal ball gazing as to year 2025, where do you see the public M&A market going? What is it that you anticipate? So I'll leave both of these with you in your good hands.
Sure. Thanks, Samir. So the first one on what is the difference between the earlier regime and the current regime, really, it's two entirely different regimes. I'll briefly explain the earlier regime. What it entailed was that when you enter into a contract to trigger an open offer, you launch the open offer, you put the open offer on the back burner, and then you separately, in a way, launch a delisting offer. And in the delisting offer, you had to go through something called a reverse book build process. So to put it in real terms, what it meant was if you have launched an open offer for 100 rupees, the public shareholders could come and quote whatever they wanted to tender their share. So they could quote 110, 200, 500 or 1000. This often resulted in absurd results where the discovered price for the delisting was so high that it was absolutely commercially unviable. Now, realizing this, what SEBI has done is it's revamped the law, and now it gives a binary option. So the acquirer itself makes an offer to say my open offer is at 100 rupees. For my delisting, I'm giving you an offer for 110, which is a premium. But that is it. That number stays at 110. You don't have the option to give me a different number, right? So it's a binary yes or no. And with that one change, it's a game changer from a structuring perspective. What has also happened is earlier, because there were two separate tendering processes where there'd be a separate tendering for the open offer, there'd be a separate tendering for the delisting, the overall timeline was much longer. And for that extended timeline, you had to pay interest. Now they've combined both tendering. So you actually tender for the open offer and delisting at the same time. And the price is discovered quicker. So your timelines are crunched. You save a substantial amount of money on interest costs. So overall, we see that this structure is something which is definitely viable and it is not to be picked up more. And on your second point, Samir, how do we see public M&A play out? I mean, I slightly partial on this one, but it's been a great year for public M&A. I think last year we've, as a firm, acted on some of the biggest public M&A deals. The market has been very busy, and I think next year as well for public M&A, it's expected to be a very busy market. You know, as they say, the corrections result in consolidation, and the sort of highs result in enthusiasm. So in either case, our fingers are crossed for a good year ahead.
Great music to your ears, I'm sure. So with that, ladies and gentlemen, we'll come to an end. I'm sorry, we're just a minute away from our hard stop. So balance questions. Rest assured, we will circle back to you after the webinar. And maybe just to quickly summarize some of the key takeaways that I took away from today's webinar. Uh, each of these deals involve navigating really complex regulatory environments, and these can significantly impact your transactional activity. And the importance of efficiency in going through these regulations and structuring with them or around them cannot be overstated. Case in point, the Reliance Disney deal. And the art of negotiating and structuring deals, it is so pivotal in M&A transactions. The competitive auction transaction Ashutosh spoke about, or how Purti explained how we work with our client in the infrastructure transaction. The strategic foresight and the adept negotiation skills. And believe you me, comprehensive due diligence is really the cornerstone of successful M&A transactions. While Tanu can't talk less or more about the diligence she did, Abhishek's insights on how, let's say, the deal could have been done a little differently just go to demonstrate the critical role of thorough due diligence. And it is really these complexities and nuances of transactional work, they highlight the indispensable role of having experienced and quality advisors with collective expertise and a strategic approach, uh, which go towards delivering client success in a multifaceted world of M&A. So before closing, we'll request each of you to respond to a poll. It should be on your slide now. This helps us collect feedback on our activities, and we take this very seriously as a part of our continuous improvement. So with that, once again, thank you to everybody who participated in today's poll, and many, many thanks to all my partners who presented such amazing case studies today and shared their expertise and their experience with us. Many thanks to you, our audience. All of this is for you and for your benefit, and we enjoy presenting these to you. We hope you found this webinar to be worth the time that you gave it. We certainly enjoy bringing these to you, and while we will send a copy of the presentation, the summary notes, and the webinar recording, we will also follow that up with a request for some feedback. Please, if you share this feedback with us, it helps us develop further and present more such activities and more such interesting uh, uh, presentations to you. If there is any interest in in-house training, or if there are any other matters arising from this webinar where we can assist, please do not hesitate to contact us. Our contact information is on the contact slide. Thank you for your time today, and we look forward to being in touch with you again during the M&A Masters series.